In this presentation, we will take a look at ratio analysis for profitability as we continue on with our financial analysis sample report. Here we are in Chapter 4, Analysis of Profitability. Profitability ratios. To analyze the profitability of a company, profitability ratios are used. These ratios measure the operating or income performance of a company. The goal of a business is to make a profit. So this type of ratio examines how well a company is meeting that goal. The commonly used ratios to evaluate profitability are gross profit ratio, net profit ratio, return on asset turnover, return on equity. So here is our information. Profitability ratio analysis. Now we're not going to go through each of the calculations of the ratio, so you can go through here if you would like to take a look at the financial statements and recalculate the ratios, but we want to take a look at the way it's displayed and then any analysis we have on the ratio. So we got the gross profit ratio, gross profit divided by the net sales times 100. And if we go down to the analysis here, and again, you could go through and you can calculate the ratios for yourself and get some practice with that. We're going to go down to the analysis. The GP ratio is showing continuously decreasing trend starting from 2004, 2005 in 28.91% to 23.79% in the financial year 2006-07. This shows the company is losing its productivity in maintaining its gross profit margin. In 2007-08, the ratio again slightly been increased from 23.79 to 25.42. So note what the analysis is trying to do there. It didn't just say, which is where most people will want to start, hey, look, the numerator went up, the denominator went down, or something like that. And that's going to explain what happened, right? We're trying to get more insight and detail into that. We want to basically see the math and say, okay, this is why it went up or down, given the math, and then tell us what that means in terms of the weakness. Notice it's basically still pretty broad what it's saying here. It's saying there's a trend, but it doesn't tell us really exactly why. We can dig down deeper and say, well, why is that happening? And then start to dig down. So just note as you go through these ratios, you want to basically know if it's going up or down. Is that good or bad? That's just basics, though. That's the beginning. And then you want to go in and say, well, what's the type of trend that this might be telling us? What group are we talking about? And then get into the specifics as to what changes did the company make for this type of trend to be happening. So then we have the net profit. So net profit calculation, we're going to go down. Once again, you can calculate it again. We're going to go down to the analysis. The NP ratio is showing declining trend from 6.49 in the year 2004-05 to 6.07 in the year 07-08, which shows there is an increase in amount of expenses in the form that increasing in the prices of the raw materials. So again, note how the explanation is happening here. It goes to why it's happening, increasing prices in the raw materials. Then we got the asset turnover ratio. We got the net sales over the average total assets. Again, you can go through and calculate that for the years using the financial statements provided. We'll go to the analysis. This ratio measures how efficiently a company uses its assets. The asset turnover ratio is decreasing, although the return on assets for the year 2008 is highest, but the asset turnover ratio is least for this year. The company is not using its assets optimally. So again, we have the analysis pretty broad there. It's not using the assets optimally because of the ratio that's being shown here. So that basically just says, hey, we know which way the ratio is going. We know what the ratio means. Again, we can obviously ask why. Why is that? What happened? It can give us some specifics as to how they're not using the assets optimally and ways for improvement. So there's always ways that we can dig down deeper into what these ratios are basically telling us, other than, well, this is good, this is bad, the ratio went up, went down. Next one, return on assets, profit after tax, average total assets times 100%. Let's take a look at the analysis. The ratio is used to measure a company's success in using its assets to earn income for earners and creditors, those who are financing the business. There is a steep fall in the year 2006 after there is a satisfactory utilization of the assets, as the graph shows. So again, it's kind of telling us the direction, which means we know what the ratio means, we know what it's doing, and we can tell you what the trend generally is. We can always go in further and say, well, why is that the trend? What is going on here? Then we have the return on equity. Again, you could do that calculation. Let's take a look at the ratio. The ROE of the company is 42.46 in 2004 and 5, which has been decreased 17.60% in 2006-07, and then slightly increased 23.21% in the 2008-07 Also, one point here to be noted is that ROE of the company is higher than the ROA, which may be due to the concept called trading on equity. So this is pretty vague. So notice we have the analysis here. We're trying to break this down. If you were to critique this, you might say, it's kind of vague here. You know, we could break that down a little bit in more detail, which is always, you pretty much always can. You can dig down into these ratios and say, well, why is this happening? If there's a significant change, we know it's increasing or decreasing. Is that significant or not? If it's significant, you know, we want to be able to tell more than, well, this went up, this went down. That's generally good. That's generally bad, because this is what that performance measure measures. We want to dig down to those specifics and say, well, what is happening? Why are these things happening? What are these ratios actually telling us in terms of what the company is doing? Has anything changed? Have the conditions changed?